Good morning, class. Today we are going to discuss chapter 12. So we're still discussing sources of funding. And more specifically, we are going to talk about informal risk capital, venture capital, and going public. Our learning objectives are the following. By the end of this chapter, you should be able to explain the basics of venture funding. You should be able to discuss the informal risk capital market. You should be able to discuss venture capital industry and its process. Also, you should be able to understand and actually apply methods for valuing a company. And lastly, you should be able to discuss the process of going public. At different stages of your business, you will need funding for different objectives. In the early stage, you need funding to get started, and that's actually when it's more difficult to obtain and it actually costs more. Later, you will need financing to develop your business. That's when you are going through your initial growth. In the third stage, you will need money to expand sales. In the fourth stage, you would need funds to get ready for an IPO. And in the last stage, you would need financing for acquisitions, LBOs, or for actually going public. Obtaining early stage financing is challenging. There are two types of capital at this stage: seed capital and startup capital. Seed capital is the most difficult to obtain, and it's usually a small amount for proof of concept and market feasibility studies. Venture capital firms are rarely involved in seed capital, except to fund a high-tech entrepreneur who perhaps has had previous success. In any case, early stage financing is essential because this is the stage where you are proving concepts, you're financing feasibility studies, you are doing initial marketing and product development. So the thing is, where does money come from? Obviously, it comes from the owners as well as friends and family and perhaps an angel investor. Once your business is up and running, you will need to continue building your business. The good news is that development financing is easier to obtain than early stage financing. Venture capitalists do play an active role at this stage of funding. Also, funds for expansion are less costly. Funds in the second stage are used as working capital that support initial growth of the business. In the third stage, which is the expansion stage, the company has a positive cash flow and uses funds for precisely that, for sales expansion. The fourth stage funds are bridge financing before the firm goes public or is purchased. Acquisition financing or leveraged buyout financing is used for traditional acquisitions, for leveraged buyouts. At this stage, you could also use the funding for going private again if you have already gone public. In broad terms, there are various markets where you can go get funding for different stages. For financing a firm's growth, there are three risk capital markets. The term risk capital generally refers to capital that investors are willing to risk for the potential of higher returns. Risk capital can be invested in various financial instruments, including equities, meaning stocks, bonds, commodities, currencies, and others. The three risk capital markets are the informal risk capital. That's an area of risk capital markets consisting mainly of individuals. The venture capital market, that is the market comprised of formal firms, and the public equity market. All three markets can be a source of funds for stage 1 financing. The public equity market is available only for high potential ventures, particularly when high technology is involved. The venture capital market provides some first stage funding, but the venture must need the minimum level of capital, starting around $1 million. The best source for first stage financing is the informal risk capital market. The private equity market, that's the enterprise capital market, provides capital for private ventures. Private equity, PE, involves direct investment into companies that are not publicly traded on a stock exchange. PE firms raise funds from institutional and individual investors and use these funds to buy and sell businesses. The market is composed of three factors: individuals, venture capital firms, and private equity firms. The primary instrument in the PE world is ownership, meaning equity in companies. In the venture capital market, the players are private venture capital firms, small business investment companies, industry-sponsored venture capital firms, geographically oriented venture capital firms, university-sponsored venture capital firms, and philanthropic venture capital funds. They invest in startups, growth equity, and mezzanine capital, which is a hybrid of debt and equity. The individual market is the least understood in the United States, but the total invested in smaller amounts is about equal to the total invested in the venture capital industry. Individual investors are called angel investors, and to be accredited investors in the United States, they must have either $200,000 yearly income or net worth, excluding primary residence, of $1 million or more, and an average investment of $220,000. Let's talk about informal risk capital market. The informal risk capital market is a group of wealthy investors, business angels, who are looking for equity investment opportunities. Typically, they invest $10,000 to $1 million. Angels provide funds for all stages of financing, but particularly startup funds. The informal investment market has the largest pool of risk capital in the United States. In one survey, 87% of investors buying private placements were individual investors or personal trusts. Another study of small technology firms found that the informal market provided 15% of the funds, while venture capital provided only 12%. In a study of angels in New England, investors averaged one deal every 2 years, and each deal averaged $50,000. The size and number of investors has increased. One study found that the net worth of 1.3 million US families was over $1 million. These families, representing about 2% of the population, accumulated most of their wealth from earnings, not inheritance. They invested over $151 billion in non-public businesses and hold no management interest. The angel money available for investment each year is about $20 billion. A recent study found that only 20% of the angel investors tended to specialize in a particular industry. So, who are these informal investors and what are they like? They tend to be well educated. Many have graduate degrees. The firms receiving investment funds are usually within 1 day's travel, so they like to invest close to them. Business angels make 1 or 2 deals a year, averaging $340,000. When they find larger deals, angels may get together with other angels to finance it. So, where do angel investors find their deals? They find their deals through business associates, friends, active personal search, investment bankers, and business brokers. A growing and common way to finding a deal is through an angel network. That's a group of angels organized into networks or funds. Each angel network or fund meets for about a few hours, about 6 to 10 times each year. The individual members of the group make the investment either individually or with others interested if any investment is made. Select entrepreneurs present at meetings and interested angels meet with the entrepreneur to discuss the investment process. So you've seen this type of presentations in shows such as Shark Tank. So crowdfunding is another way of financing your business. It is also an individual investment. It differs from traditional funding models as it's based on networks and individuals and sometimes companies. It can be used to pre-test a product or a service. The Jumpstart Our Business Act, Jobs Act, relaxed rules over the general solicitation of funds in equity funding, paving the way for crowdfunding. Crowdfunding brings together various individuals who commit money to projects and companies they want to support. One type of crowdfunding is called reward-based crowdfunding. This is when individuals pledge money to a company which might be developing a new technology product, a new cultural art project, or a new musical album. In other words, in reward-based crowdfunding, individuals contribute to a project or business venture in exchange for a non-financial reward. Often, this is in the form of the product or service or a unique experience related to the project. So how does it work? A creator presents a project or idea on a crowdfunding platform, outlining its goals, the funds required, and the rewards offered for different contribution levels. Backers, that's individual contributors, choose a reward tier based on how much they're willing to contribute. If the project reaches or exceeds its funding goal by the deadline, the creator receives the funds, minus the platform fees, and proceeds with the project's development. Once the project is completed or reaches a certain milestone, backers receive their chosen rewards. An example would be, let's say that there's Let's check out an example on a crowdfunding platform called Start Engine. They have lots of opportunities here where individuals can invest. Let's take a look at this one right in the middle called Flower Turbines. They have already raised $2.87 million. And as you can see, there's almost 1,500 investors, the minimum investment being $600. So let's check them out. And you can see how easy it is to invest in them. Now, why do I want to invest? And they give you the reasons here. And let's take a look at the rewards. And as a first tier investor, you would receive 5% bonus shares. As a tier 2 investor, you would receive 10% and so on. There's also another type of crowdfunding that would be lending crowdfunding, and it allows borrowers, usually companies, to incur debt funds without going to traditional providers. Lending crowdfunding is often referred to as peer-to-peer lending or P2P, or debt crowdfunding. It's a method for raising capital where individuals lend money directly to individuals or businesses in exchange for a promise to be repaid with interest. This method bypasses banks, making the borrowing process generally quicker and often more flexible. The interest rate can be set by the platform, or it can be agreed upon between the borrower and the lender. How does it work? A borrower applies for a loan on a P2P lending platform. The platform assesses the borrower's creditworthiness and assigns a risk category or interest rate. Investors or lenders can browse loan requests and they can decide where they want to invest their money. Once the loan is fully funded, The borrower receives the money minus any fees for the platform. The borrower makes regular monthly payments, principal plus interest, which are distributed back to the lenders. A P2P platform would be something like Prosper or Lending Club, one called Funding Circle. And what you would do is you would give information about your company and tell them how much money you need. It would ask you questions. We're not going to go through the entire application, but it'll ask you questions about your company, your net profits, how long you've been in business, your credit history, if you're a sole prop, and so on. There's also another type of crowdfunding called equity crowdfunding, and it allows individuals to invest in private companies for a percentage share of the company. In essence, it refers to the process where individuals invest in an early stage unlisted company, meaning a company that is not listed on a stock market, in exchange for shares or a small stake in that company. This contrasts with reward-based crowdfunding, where contributors get a tangible product. However, you can also see hybrids. For example, in the first company that we saw, Flower Turbines, they were offering shares, and then the rewards were a 5% on top of what your money was getting you in terms of shares. Equity crowdfunding platforms don't just operate in the United States. They operate in various countries under different regulatory frameworks. There are also other types of crowdfunding. Some focus on real estate and human capital. For example, there is donation-based crowdfunding. People contribute to causes they want to support and they have no expectation of a tangible return. There's royalty-based crowdfunding. Investors contribute funds in exchange for a share of the future revenues or profits of a business. For example, a musician might offer royalties. Real estate crowdfunding. Investors pool their funds to invest in property-related projects, and they might earn returns based on rental income and or the appreciation of the property. Successful crowdfunding campaigns take time and planning to develop a solid marketing campaign. You will need to first determine which crowdfunding site you will use. Then you'll need to create materials to explain your story, such as a video. You will need a budget. You will also need to identify what you want to fund. Are there tasks or projects or acquisition of equipment and so on? You'll need to structure rewards and tiers. And lastly, you'll want to have a deadline for the campaign. Let us turn our eyes from crowdfunding to another way of raising funds, and that is venture capital. Venture capital is a type of financing where investors provide money to startups and small businesses that they believe have long-term growth potential. In return for their investment, the investors usually receive ownership shares in the company. The main goal for the venture capitalist is to invest in a company early and then sell their stake for a significant profit after the company grows and becomes more valuable. Venture capital, broadly, is a professionally managed pool of equity capital. The equity pool is formed from resources of wealthy limited partners. Other investors are pension funds, endowments, and other institutions, including foreign investors. The pool is managed by a general partner in exchange for a percentage of the gain realized and a fee. The venture capitalist takes an equity participation through stock, warrants, and or convertible securities and has an active involvement in monitoring of each company, bringing investment, financial planning, and business skills to the firm. The role of venture capital became institutionalized after World War II. In 1946, American Research and Development Corporation, ARD, was formed in Boston. The ARD was a pool of capital from individuals and institutions put together by General George Doriot to actively invest in emerging businesses. The Small Business Investment Company Act of 1958 married private capital with government funds for small business investment companies, SBIC firms. SBICs were the start of the formal venture capital industry. A significant expansion of SBICs occurred in the 1960s, but many failed due to a variety of reasons. The SBIC program was restructured, eliminating unnecessary government regulations and increasing the capitalization required. There are approximately 360 SBICs operating now, of which 130 are minority small business investment companies funding minority enterprises. During the late 1960s, small private venture capital firms emerged, usually formed as limited partnerships with the venture capital company acting as general partner. The limited partners, usually insurance companies, endowment funds, bank, trust departments, pension funds, and wealthy individuals and families, supply the funding. There are over 900 venture capital establishments in the United States. During this time, venture capital divisions of major corporations were formed. Corporate firms invest more often in technology or new market acquisitions. Some corporate firms have not had strong results, unfortunately. The geographically oriented venture capital fund was created in response to the need for economic development on a state basis. While these state-sponsored venture capital funds vary, each fund is typically required to invest a portion of their capital in the particular state. Besides the four types already discussed, there are university-sponsored venture capital funds and philanthropic venture funds. The venture capital industry was fairly steady in the early 2000s. The number of deals began steadily increasing starting in 2011 to hit a high in 2018. To summarize, these are the types of venture capital firms. We have private venture capital firms. These are specialized firms whose primary goal is to identify, invest in, and nurture early-stage companies with high growth potential. They pull funds from various sources like institutional investors, wealthy individuals, endowments, and pension funds. In exchange for their investment, they typically receive equity in the companies they fund. Then we have small business investment companies, SBICs. SBICs are privately owned and operated companies that are licensed by the Small Business Administration to make equity capital or long-term loans to small businesses. They invest their own capital and can borrow additional funds with an SBA guarantee. Their goal is to help small businesses get the necessary capital to grow. There are also industry-sponsored banks and other financial institutions, as well as non-financial companies. While traditional banks generally offer loans rather than taking equity stakes in startups, some have specialized venture arms or subsidiaries that make equity investments. On the other hand, non-financial companies such as large tech or pharmaceutical corporations might have corporate venture capital, CVC, branches that invest in startups, often in areas strategically aligned with the parent company's interests. We have geographically oriented venture capitalists. These are venture capitalists who focus on investing in companies based in specific geographical areas. Their investment strategy is often driven by regional development goals or specialization in local industries. We have university-sponsored venture capital firms. Many universities, particularly those with significant research programs, have established venture funds or investment arms to help commercialize innovations and technologies developed within their institutions. This venture capital branches invest in startups that emerge from university research or are founded by university affiliates. Lastly, philanthropic venture capitalists, also known as impact investors. These VCs look to invest in companies that not only promise a good financial return, but also aim to generate positive social or environmental impacts. Their goals often extend beyond pure profit to include measurable societal benefits. Each of these venture capital types has its own unique focus, investment criteria, and goals. For entrepreneurs, understanding these differences can help them target the right type of investor for their specific needs and goals. The objective of a venture capital firm is to generate long-term capital appreciation through debt and equity investments. The objective of the entrepreneur is survival of the business, and the two objectives sometimes can be at odds. There is more risk in financing a business early in development, so more return is expected, 50% ROI, than in later development. Venture capital firms feel pressure from investors to make safe investments, so they invest in later stage financing. Usually, the venture capitalist does not seek control of a company, but prefers the firm and the entrepreneur to have the most risk. Venture capitalists will want at least one seat on the board of directors. The venture capitalist will support the management team so that the business and the investment will prosper. The company's management team is expected to run the daily operations. Mutual trust is important between the entrepreneur and the venture capitalist. So, what criteria do venture capitalists look at? They want the company to have a strong management team with solid experience, strong commitment, capabilities in the field, and flexibility. A venture capitalist in general would rather invest in a first-rate management team and a second-rate product than the reverse. The management team's commitment should be reflected in dollars invested in the company. The second criteria is that the product must be unique, and the final criterion is that the business opportunity must have significant capital appreciation. The process of implementing these criteria involves the venture capitalist's intuition, their gut feeling, plus the systemic approach and data gathering techniques, science. So it's a mix of art and science that leads them to their ultimate decision as to whether to invest or not. The return on investment criteria for venture capitalists or VCs can vary depending on the stage of the company in which they are investing. Here's an overview of ROI expectations for different stages. For early stage investments or seed stage investments, the risk level is highest. The company may just have an idea or a prototype and may not have proven its business model. Because of that, the ROI expectation is the highest. Due to the higher risk, VCs expect a significant return on their investment. They might seek returns of 10 times their investment or even higher within 5 to 7 years. The reason is that given that many early stage startups fail, VCs need the successful investments to not only cover the losses from the failed ones, but also provide a healthy profit to their fund. If they're looking at development or expansion financing, they're looking at a moderate risk level. This is when the company has a working product, they have a customer base, and they are generating revenue, but might not be profitable yet. They need funds to expand their operations, enter new markets, or increase production. So, their ROI expectation is moderate to high. You can see 40% ROI. VCs might target a return of 3 times to 5 times their investment within 4 to 6 years. Why? While the risk is lower compared to early stage investments, there is still a significant amount of uncertainty about the company's future growth and profitability. When they're looking at acquisition or later stage financing, the risk level would be the lowest among the 3 stages. The company is well established, they have a significant market presence, and they're probably already profitable. They might need funds for acquisitions, entering new big markets, or preparing for an IPO. Consequently, the ROI expectation is lower, 30%. VCs might seek a 2-time to 3-time return on their investment within 2 to 4 years. The company's growth and profit trajectories are more predictable at this stage, and so that makes the investment less risky. And because of the reduced risk, the potential ROI is also lower. Having said all of this, it is essential to remember that the exact ROI expectations can vary widely. For example, a VC firm specializing in biotech startups might have different ROI expectations and timelines than one focusing on software startups, given the different natures of those industries. Similarly, venture capitalists investing in rapidly growing markets or sectors might have higher ROI expectations than those in more stable or mature markets. The process can be broken down into 4 stages: preliminary screening, agreement on principal terms, due diligence, and final approval. So, how to locate and approach venture capitalists? First, approach only firms who may have an interest in the investment opportunity. There are several areas of concentration: Los Angeles, New York, Chicago, Boston, and San Francisco. So, what are some of the things that you can do to find VCs? Number 1, networking. Personal contacts. Often, the best introductions come from a personal connections. So you should talk to your network of friends, colleagues, mentors, and other entrepreneurs because they might have connections to venture capitalists. Attending industry events and conferences. Many venture capitalists attend conferences, seminars, and startup pitch events. These gatherings provide an opportunity for you to meet and build relationships with potential investors. Also consider startup accelerators and incubators. Joining an accelerator or an incubator program can provide you with both initial seed funding and introductions to larger VC firms. Number 2, online platforms and databases. AngelList. This is a platform for startups to meet investors, where you can create a profile for your startup and you can connect with VCs. Crunchbase. Crunchbase is a database of companies, startups, and investors where entrepreneurs can find VCs based on their investment history and interests. And LinkedIn. Many VCs have profiles on LinkedIn. Also consider researching venture capitalist firms' websites. Most venture capitalist firms have websites that list their investment criteria, portfolio companies, and contact information. You'll see that some venture capitalists specialize in certain industries or stages of business. So you will need to make sure that you find out this information so that you can target VCs that align with your startup sector and stage. Nothing beats a warm introduction. So if you identify a venture capitalist you would like to approach, it would be really beneficial to find a mutual contact to make an introduction if you're able to. You can also look at VC blogs and publications. Many VCs write blogs or articles about their perspective on the industry. So reading these blogs can give you a sense of their interest, and also this could be your conversation starter. Of course, you can also do cold outreach. It's not the most recommended. However, cold emails or calls could work, especially if they are well researched and personalized. You can showcase your business at pitch events. Some cities or entrepreneurial communities host demo days or pitch events where startups can present their ideas to a room full of investors. University alumni networks might also be a source of information about venture capitalists. Many universities have strong alumni networks, some of whom might be VCs or may have connections to the VC world. Lastly, you can also hire a professional intermediary. Some startups use financial consultants or brokers to help them find and negotiate with potential investors. Lastly, I'll say that securing venture capital isn't just about finding any investor. You're looking for the right investor. It is essential to conduct thorough research and due diligence to ensure there's a good fit between the entrepreneur and the venture capitalist. Not just in terms of business alignment, but also interpersonal dynamics. Let's say that you've obtained a meeting. How would you approach that person? How would you approach the VC? Prepare, prepare, prepare. Make sure that you have practiced your pitch. Make sure that it's concise, to the point. Don't take more people than you need to. Be very professional. And at the very least, if they say no, you'll have gained experience. If they say no, ask what you could do to improve on your presentation or on your plan. Look for information. They see hundreds of businesses or pitches, and so they have a lot of experience. If you have them in front of you, take advantage of that experience. Keep in mind that the response is not personal, so don't take it personal. Just think that this is business. They're looking at numbers. If they say no, it might be because they're looking at different industries. They might be looking for a different rate of return. They might be looking for something else. So it's really important to keep yourself grounded in the idea that this is not personal. You are not your business. You're seeking financing for your business, but when you receive a no, they're not rejecting you, the person. They're rejecting the business. So it's really important to keep this idea in mind. That way you don't get too discouraged. But eventually it's a matter of numbers, right? So eventually somebody will say yes. And you have to have that clear in your head that somebody will say yes. It will happen. All right, that's it for part 1. Until the next recording.